Insurance Industry News, February 12, 2026. AI disruption, Insurify's ChatGPT app rattles insurance industry. A new artificial intelligence tool is shaking up the insurance world and sparking turmoil among traditional brokers. Online insurance marketplace Insurify announced the launch of a groundbreaking ChatGPT-powered app that lets consumers compare and shop for auto insurance through a conversational AI interface. The app, one of the first 100 third-party apps in OpenAI's ChatGPT plugin store, taps into Insurify's database of 196 million auto insurance quotes and 70,000 customer reviews to provide personalized coverage options and carrier recommendations directly within a chat session. According to Insurify's CEO Snejana Zakaria, buying car insurance can now be as simple as having a conversation, as the app allows drivers to ask questions in plain language, receive tailored quotes, and read real customer reviews, all without leaving the ChatGPT platform. The goal is to streamline one of the most tedious consumer chores, shopping for insurance, by bringing it into the era of conversational AI. With our new ChatGPT app, we're redefining the insurance shopping experience by making it feel as simple as having a conversation, Zakaria said, emphasizing that the tool combines AI with Insurify's extensive quote data to quickly match drivers with policies that fit their needs and budget. Users can even jump from the ChatGPT comparison to finalize their purchase with a licensed Insurify agent seamlessly. This first-of-its-kind InsuranceTech app demonstrates how AI might soon play a central role in insurance distribution, but it's also causing shockwaves in the traditional brokerage sector. PRNewsWire.com. In the aftermath of Insurify's app launch, U.S. insurance broker stocks plunged on fears that AI-driven platforms could upend the industry. On February 9, the S&P 500 insurance index dropped 3.9%, its worst single-day fall since October, and some brokerage giants saw their share prices tumble by nearly double digits. Willis Towers Watson stock plummeted 12%, its steepest one-day decline since 2008, while Arthur J. Gallagher fell 9.9% and Aon plc lost 9.3%. Analysts pinned the sell-off on investor anxiety that tools like Insurify's ChatGPT app could disintermediate insurance brokers by automating insurance shopping. The insurance broker stocks are getting hammered, observed Bloomberg intelligence analyst Matthew Palazzolo, noting concerns that Insurify's AI-driven platform, along with new automation tools from AI startups like Anthropic, may be a threat to some consulting businesses of insurance brokers. The fear is that advanced AIs could handle tasks like policy comparisons and risk assessments that clients traditionally relied on human brokers for, potentially cutting into brokers' commissions and market share. StraitsTimes.com, StraitsTimes.com. However, industry experts urge caution before writing off human brokers entirely. Palazzolo and others suggest these AI tools might become a force multiplier rather than an existential threat, boosting efficiency for brokers who adapt, instead of fully replacing the human element. They point out that commercial insurance, complex risk advising, and claims advocacy involve personalized, nuanced services that automated tools cannot yet replicate. Brokers could even adopt AI themselves to enhance client service. Still, the dramatic market reaction underscores the insurance sector's recognition that AI-driven innovation is here, and it's moving fast. Insurify's ChatGPT app went live on February 3, and within a week it sparked a reshuffling of market value in the brokerage space as investors recalibrated expectations. The episode highlights a broader trend: insurance technology, InsuranceTech, is rapidly evolving, and incumbents may face disruption if they don't evolve in tandem. StraitsTimes.com. Cyber insurance market sees premiums drop amid rising attacks. A new industry report reveals a puzzling trend in cyber insurance: premiums are falling even as cyber losses mount. Insurance broker Lockton released a market update showing that cyber insurance premiums declined by an average 11% in 2025, despite a dramatic increase in cyber incidents and claims. The UK's National Cybersecurity Centre recorded a 129% spike in nationally significant cyber incidents in the 12 months up to August 2025, including some of the worst ransomware attacks on record. Yet over that period, greater competition and appetite from insurers drove cyber policy rates down by roughly 10 to 11% on average for companies renewing coverage. Lockton's analysts call it a rare divergence between underlying risk and insurance pricing, as one would normally expect a surge in cyber losses to drive higher premiums. Instead, the cyber insurance market has remained soft, good news for insurance buyers, at least for now. Advertisem, Shout.com. Several factors are contributing to this counterintuitive soft market. New entrants, including managing general agents, MGAs, syndicates, and insurers, have been pouring fresh capacity into cyber insurance, intensifying competition and keeping prices in check. At the same time, many insurers have expanded coverage offerings, adding benefits like broader anyone claim aggregates and business interruption extensions to attract customers. According to Lockton, the result is wider coverage and continued price competition even after some of the worst cyber incidents in recent history, including major ransomware attacks that significantly impacted companies' bottom lines in 2025. One UK cyber attack in 2025 had such a direct, material impact on consumers that it dramatically raised public awareness of cybersecurity risks. Overall, claims frequency jumped about 20% last year, primarily data breaches, and while ransomware made up just 16% of incidents, it accounted for roughly 75% of total claims payouts. In other words, ransomware is less frequent, but its impact is massive, the report noted. Advertisem, Shout.com, Advertisem, Shout.com, Advertisem, Shout.com. Lockton's cyber experts caution that today's bargain premiums may not last. The company's head of cyber and technology, Carlo Marengo, in an analysis reported by Advertisement Shout, said that cyber insurance remains a buyer's market in 2025 to 26, with insurers willing to write new risks and policyholders enjoying historically competitive rates. But he warned that the steady premium decline may soon bottom out. Historic claims, particularly in the United States, could pose a challenge to the market as losses accumulate in 2023 and 2024, Marengo explained, adding that this could pressure profitability and lead to another volatile pricing period by 2027. In other words, if the recent wave of cyber losses starts to hit insurer financials, the current soft market might harden again with rate increases or tighter coverage in a few years. For now, however, insurers' choice and competition mean premiums remain low even as incidents rise, making it a good time to buy cyber insurance for many organizations, Marengo noted. Risk managers are advised to seize the moment to secure broad coverage at favorable rates, but also to thoroughly re-evaluate their coverage limits and cybersecurity postures while prices are advantageous. Advertisem, Shout.com, Advertisem, Shout.com, Advertisem, Shout.com. Legal and climate update. Texas anti-woke law overturned amid ESG debate. In regulatory news, a court decision in Texas could reverberate across states and the insurance investment landscape. A federal judge in Texas struck down the state's 2021 law that blacklisted woke financial firms, like BlackRock and other asset managers, for considering environmental, social, and governance (ESG) factors in investments. The law, known as the Energy Discrimination Elimination Act, had required state agencies to divest from firms deemed hostile to fossil fuels. The judge ruled the law unconstitutional, saying it violated free speech rights by punishing companies for their climate change policies and affiliations, a home court loss for Texas, as one attorney put it. Texas officials plan to appeal, but experts say the ruling provides a roadmap to challenge similar anti-ESG laws that have been passed in at least 14 other states including Oklahoma and West Virginia. The decision's challenge to the idea that considering climate or ESG factors is purely political clears the way for many of these laws to be contested, noted Brian McGannon of USCF, a sustainable investment forum. In short, this court case may slow the momentum of state-level efforts to ban socially conscious investing in favor of fossil fuels. InsuranceJournal.com, InsuranceJournal.com, InsuranceJournal.com. The backdrop to this fight is the growing financial toll of climate-related risks, which many insurers and asset managers say they must consider. Just last month, global reinsurer Munich Re reported that natural disasters caused $224 billion in economic losses in 2025, including record-breaking losses from wildfires and storms. The devastating Los Angeles area wildfires of 2025 alone cost an estimated $53 billion in damage, yet only $40 billion was insured, leaving a huge $13 billion protection gap. Such numbers underscore why investors like BlackRock have been urging companies to address climate risk. Critics of the Texas-style anti-ESG measures argue the laws politically punish investors for prudent risk management in the face of escalating climate losses. Environmental finance advocates hailed the judge's ruling as a strong signal that the overreach of anti-ESG laws has more bark than bite, reinforcing that the freedom to consider climate and sustainability factors in investing is protected. For insurers, who are both major investors and on the front lines of climate disasters, the decision is seen as supportive of using all available data, including ESG insights, to guide investment and underwriting decisions in a changing risk environment. InsuranceJournal.com, InsuranceJournal.com, InsuranceJournal.com. Market and Corporate, Nationwide acquires Surety/Fidelity business from MSA. In corporate news, major insurer Nationwide is making a strategic acquisition to bolster its specialty insurance portfolio. The Columbus-based insurance giant announced it has agreed to acquire the renewal rights for the Surety and Fidelity bond business of Main Street America Insurance, MSA. MSA is a subsidiary of American Family Insurance specializing in surety bonds, which are used to guarantee contractual obligations. Under the deal, which is expected to close by the end of the first quarter, pending regulatory approvals, Nationwide will take over MSA's book of Surety and Fidelity bond business, offering renewal of those policies under the Nationwide brand. Coverager.com. Nationwide's leaders say this transaction expands the insurer's presence in the surety market. This acquisition allows us to enhance our surety and fidelity offerings and deliver even more value to our agents and customers, said Kurt Walker, CEO of Nationwide. He welcomed MSA's policyholders and employees into the Nationwide family and emphasized the company's commitment to a seamless transition for agency partners and clients of MSA. Main Street America's surety operation has a strong reputation for working with independent agents to provide contract and commercial surety bonds across the country. By absorbing MSA's established portfolio, Nationwide gains scale and expertise in the niche but growing surety and fidelity bond market, which is often tied to construction projects and corporate obligations. Russ Johnston, president of Nationwide Specialty and Commercial Lines, noted that surety is a strategic growth area for the company, and that with Nationwide's greater financial strength and resources, agents can expect the same level of service and stability, now backed by Nationwide's scale going forward. The move illustrates continued consolidation in the insurance industry, as large national carriers like Nationwide seek to acquire specialized books of business to broaden their product offerings and fuel growth. Coverager.com. Quick hits, auto insurance prices stabilizing. Auto insurance premiums ease after steep climb. Consumers received a slight reprieve in car insurance costs last year. A new Insurify study finds the average U.S. full coverage auto premium fell 6% in 2025 to about $2,144, after soaring 46% in the hard market from 2022 through 2024. However, don't expect ongoing relief. Rates are projected to rise 1% in 2026 to reach a $2,158 average nationwide. The national downturn in 2025 wasn't uniform. 39 states saw decreases, with 8 states down 15% or more, while a handful of high-cost markets actually saw double-digit increases. For example, New Jersey's premiums jumped 20% in 2025, and Washington, D.C. hit a nation-high $4,017 average annual cost. Insurify's analysts say urban congestion, more accidents, and pricey repairs in such areas are driving rates up despite broader trends. In contrast, some smaller states enjoyed huge drops. Wyoming, Iowa, and Arkansas each saw average prices plunge by over 20% in 2025. The gap between the most and least expensive states is widening, raising concerns about an insurance affordability gap in states like New York, New Jersey, and Florida versus states like Wyoming or Maine. Insurify warns that factors like inflation and repair costs, including pending tariffs on auto parts, could push auto insurance prices higher in 2026, particularly in already expensive regions. InsuranceJournal.com, InsuranceJournal.com, InsuranceJournal.com. Reinsurers pull back on optimism. Global rating agency AM Best has revised its 2024 outlook for the reinsurance sector from positive to stable, reflecting concerns that the reinsurance boom may moderate. After last year's steep rate hikes, property catastrophe reinsurance pricing has begun to decline from its 2023 peak, and there are growing worries about deteriorating loss trends in casualty lines, like liability insurance, that could erode profitability. Reinsurers have imposed higher retentions, deductibles, on ceding insurers in recent years, but if pricing momentum fades and claims inflation grows, those measures may not fully offset the risk. AM Best now sees the industry on surer footing but without further positive momentum, hence the stable outlook for 2024. The big reinsurers enjoyed strong results from the January 1st renewal season, For example, AIG's CEO Peter Zaffino noted the company achieved enhanced terms and favorable pricing in its January 1 treaty renewals, but the easy gains may have been realized for now. Analysts say the market remains well capitalized and able to pay claims, but reinsurers will be closely watching liability loss developments and economic trends to gauge if further price increases might be needed in 2026. FocusEfforts.com. Video tags, Insurance News, Insurance Industry, InsuranceTech, ChatGPT, Artificial Intelligence, Insurance Brokers, Insurify, Cyber Insurance, Ransomware, ESG, Climate Change, Insurance Regulation, Texas Law, BlackRock, Insurance M&A, Surety Bonds, Insurance Trends 2026. Video description. Today's insurance industry update dives deep into the latest headlines shaping risk and coverage. We explore how a new AI-powered insurance shopping app by Insurify is rattling the broker business, sending some brokerage stocks tumbling on disruption fears. We also examine a surprising trend in cyber insurance. Premiums are falling even as cyber attacks surge, according to a new Lockton report. In regulatory news, we break down a Texas court's decision to strike down an anti-ESG anti-woke law, a ruling that could have nationwide implications for insurers and investors considering climate and sustainability risks. On the corporate front, we cover Nationwide's acquisition of Main Street America's surety and fidelity bond business, and what it means for the insurer's growth strategy. Stay tuned for these stories and more in our in-depth insurance news report. Thumbnail concept, a visually engaging thumbnail highlighting the day's top insurance news themes. The central image could be a split-screen design, on one side, a shattered stock chart, symbolizing the broker stock plunge, and on the other side, the ChatGPT logo or a robot icon shaking hands with an insurance agent, to represent the AI in insurance.